get through in 20 minutes. If you don't believe I'm going to do it in 20 minutes, I've even got a stopwatch in front of me to make sure I do it. So let's kick off. You might want a cell phone to record this. I will also send a link of the replay, but you can take pictures of the images as we go by. So let me know you can see and hear me loud and clear, and we'll start kicking off straight away. Sorry if you're late, any of you. So let's start the weekly update. And first things first, which came across my desk, which I thought was interesting and worth sharing with you, was this report from Bank of America. They think there's 16 battered tech stocks that will turn the strong cash flow they're generating into returns, even though that sector has been suffering. So we went through those 16 stocks and then we cross-referenced them with my own filtered list. If you're familiar with the way I work, I have an approved filtered list of stocks which goes through the valuation of those companies, revenue growth, dividend yields, cash flow. So I look at more things than what Bank of America do. So let me share their names. Now, none of their names met my approved filtered list. Like I said, I have more stringent criteria, but for your interest, I thought I'd share these with you. And by the way, the methodology they used was free cash flow relative to enterprise value. Okay. And they're looking for the largest free cash flow compared to the value of, or the enterprise value of the company. Enterprise value, relatively complicated accounting measurement, but it's liked by some people. And free cash flow, think of it in terms of the unencumbered cash that a business generates. And they want the highest multiple or the highest percentage that they can find. So Seagate, like I said, these didn't make my approved filtered list, but I'm sharing them with you anyway. Micron, Cisco, Qualcomm, Lam Research. I've owned Lam Research and Cisco in the past. They were on my approved list previously, and I hold things which are on my approved list for 12 months, even if they, in the subsequent month or two, might drop out, just so you know the approach, because we don't trade our investments. Once they're on the list, they're purchased for 12 months and held for 12 months unless they drop 25% from the peak. Teradyne I've owned in the past as well. Okay, so Meta I've owned in the past, and I've spoken about this separately on my various social media, on my LinkedIn. And actually today on LinkedIn, I put up an update on Meta and where I think the directions are going. Okay, Global Payments, F5, Gartner, Accenture, EPAM, Advanced Micro, that I've owned in the past as well. Okay, none of those were on my approved filtered list, but they were on Bank of America. So I just wanted to share those with you. Now, what you can see here, and I wanted to again share this with you, is the price earnings ratio of some of the big companies, the ones you're familiar with. And of course, green is good. Lower the price earnings ratio, the lower the valuation of a company, the more attractive it should be, all other things being equal. But we don't just want to look at valuation alone, of course. There are other factors such as momentum. But I want to share with you, Amazon comes up. A few others have come up on the banking sector, on insurance, asset management. That in and of itself doesn't necessarily mean much. And you can still see there's some on the tech side of things as well that have, on the oil and gas and energy side of things, which have come up as well. Well, what other factors might we want to look at? We might want to look at momentum. How are things performing? And once again, you can see energy. And actually, what I want are things which are green in each of these charts. So I want the valuation to be low and I want momentum to be strong. So this is their weekly performance. And the energy stock keep going up. Okay. But I still need them to be undervalued, and they're not too overvalued either. And this is another measurement of valuation, which shows greater attraction for that sector, and the stocks named in them is price earnings growth, and you want that to be below 1. So it's a measure of the price of a company relative to the rate at which its earnings or profits are growing. And earnings and profits are interchangeable words. What you can see there is energy and banks are coming up in segment after segment. Amazon keep coming up as well. And it's a method of filtration, because we've got momentum, we've got valuation, we've got another measure of valuation. You want to try and see how many of those have greens coming up in all three. I'll come to specific names of what I own in a second, but I wanted to do a top-down first, and that oil and gas and energy companies, I don't think, are either running out of momentum or running out of being overvalued either at the moment. Okay. So let's have a look going forward. How are we looking on the S&P? Well, as you all know, I've been waiting, and it's now June. I've been waiting since January each week, thinking, oh, well, we'll see how it goes next week. And the markets drop and the momentum's lower. And this is starting to form something of a base. So for those who, even if you're investing for 12 months and you're looking at this on a weekly basis, just to understand the markets, what you can see is it's forming something of a base. But I'm still going to wait a week because things still look fairly negative to me on the charts, on the technicals, let alone trying to read the fundamentals of the markets and macroeconomics. This looks a lot worse. This is the monthly version, and you can see the rate at which that's dropping. Think of that as if it was an arrow or a missile. Well, you can tell the blooming direction it's going in. It's downwards, and it's going down with some force. That's the way to read it. So that momentum, when people get a bit excited because they see 3 days of the market rising, and then I say, well, wait. So I'm going to wait another week at least and reevaluate. I suspect I won't be looking at investments until July now, okay? And even then, I might not be looking at anything. And you can see Apple is forming a similar path. It does try and make a couple of weeks worth of rises. Everyone gets all excited, and then the downward pressure continues, which is better illustrated when you flip across to the monthly chart, and you can see that maybe the decline's just started. And it's got nothing to do with Apple in and of itself. You can make up all sorts of excuses that Apple has not got this, not got that, whatever. Actually, it's still a solid company. Microsoft, very similar kind of picture. Looks like it's forming a base, but when you look at the monthly chart, the question you've got to ask yourself is not when will I get in, but do I need to make that decision today? Okay, and if you don't need to make the decision today, say, well, I'll wait another week and I'll make a decision, or I'll wait another month. And that's what I've been doing. I've been doing that since January. And you might say, well, wait a minute. What does that mean for you, Alpesh? Well, it means I've saved myself a hell of a lot of money, is what it means. Amazon, similarly, on the weekly, looks like it's forming a base. People get all excited that it's moved up and it's had this split. However, I'll still have to wait and see, I'm afraid, because the momentum is still down and I don't need to be rushed or pushed or cajoled into making a decision. I won't do it. Similarly with Meta, they get all excited as if the bus is, or the train is leaving the station. Well, let's just wait another week and see what happens. And that's where you want to watch these weekly updates. Even if you're looking to invest for 12 months, let's just wait another week and see what happens. Costco, I've liked in the past. I had to get out because, look, we got out. I can't remember whether it was a 10% gain or 25% gain. Anyway, we got out of it. It was in my son's ISA because it dropped from the peak. And when it dropped 25% from the peak, I had to get out because those are my rules. And it looks like I'm not going to get back in yet because on the monthly, it still looks like it's flattening to maybe even falling further. PayPal, famously one that I like, and it's dropped a lot further than I thought it would, but I still like it, and I think it's a good one for the future. And we're at multi-year lows. Am I getting in yet? Nope. Am I going to buy some more yet? Nope, not yet. This might be a leader of what's going to happen to some of the other tech companies because this has fallen further than some of the others, and the others might catch up and follow this a lot lower. So this might be the first one in and the first one out of these declines. We'll see. But do I need to make a decision today? No, I'm not going to make a decision today on PayPal and buying more. But when I do, I'll post it on Telegram and on these weekly updates. You can be sure of that. I'll have a look at some of the others that I happen to own. Okay, Westlake still looks upward and fine. Qualcomm got a bit of a base. I don't think I own this at the moment, but it's one which has been popular with people. It's looking like it's going down. Look, you can see it's come off the peaks. That one, Johnson & Johnson, again, keeps coming up. Not one I believe I own at the moment. Keeps coming up a lot on a lot of the analysts, a lot of the hedge funds, people looking for safety, particularly the big institutions. But I can see here it's just going sideways at the moment. So would I look to get into it now? Not right now. Qatar Energy, I do own, and it's been doing okay. It's been doing okay. I wish I bought it 6 months ago, 8 months ago, 10 months ago, but I hadn't. It only came in the last 2 or 3 months, and it's already gone up about 15%, if not more. Similarly, Halliburton I own, and there's been that tactical shift from technology to energy. Now, if you asked me 12 months ago, would you be buying a load of energy stocks? 12 months ago, I'd have said, no, not really. Why would I look at energy? Why would I give it any special tactical benefit? Nope. Would you be getting out of tech stocks if you asked me 12 months ago? I said, no, why would I look at like I'm getting out of tech? What happened? The tech dropped 25% from their peaks. I had to get out of them. And then the oil companies, the valuations and the revenue growth and the everything else looked fantastic. The profits suddenly look great. Not for you as a consumer, but they look great for the bloody companies. So if you can't beat them, join them and start owning a piece of them. So Marathon Oil, Occidental Petroleum, just so you know, I own these. Mosaic we had to get out of because it's fallen from its peak. So I think there were slight gains or nothing much to write home about. It rose, then it fell. There you can see it there. So I had to get out of. Devon Energy still in that and still rising. Marathon Petroleum. There's two Marathons, petroleum and oil. Okay, own both. But I do. Valero Energy as well, still got, and you can see sort of the sharp rise. Like I said, think of it as a missile and a trajectory. It doesn't mean it guaranteed to continue that direction, but it is. Lots more to go. We're only at 40 minutes through and halfway through this, by the way. Sorry, halfway through this and 40 slides. So all part of my campaign for $1million.com. If you've not looked at it and all the free materials there, have a look. It's to make 1 million people better investors. This, defensive stocks to own during stagflation-like periods. Stagflation, so low growth or recession, and high inflation. Not nice. Okay, what, according to Jefferies, the bank Jefferies, you can see I've marked it down there. You can sort of see it down there, I believe, where I'm moving my mouse. At the bottom, from Jefferies, they have listed these companies. Well, that's up to them. But I just wanted to share that with you. They believe in the stagflationary period, these types of companies do well. You can see there's some food companies, there's energy, so-called defensives, basically, pharmaceuticals. Defensives are things which, no matter how the economy is, you're still going to have to pay for those things like energy and food and pharmaceuticals, aren't you? You know, you're going to fall sick, you're going to need to eat, and you're going to need to keep warm. Scion Asset Management, who are they? If you've watched the film The Big Short, then Michael Burry is the hedge fund manager, one of the hedge fund managers who foresaw the financial crisis. So he gets a lot of attention. And he's bearish at the moment. He thinks the markets could fall another 50%. So it's worth asking, okay, Mr. Burry, Mr. Know-it-all, what's in your portfolio? That's what's in his portfolio. All right? That's what's in his portfolio. So that's what he hasn't got to cash. He's got these, interestingly enough. Right? So he's got some pharma, got some tech still, but that's what he owns. Berkshire Hathaway, you know him. Warren Buffett. Well, what does he own then? This is what he owns, right? You can see it there. Take a picture if you wish. I can't dwell on these for too long, but any that I own, I'll let you know. You know I own Occidental. I don't happen to have Chevron, but it's in the energy sector, but you can see what I happen to own. And it goes back to the earlier story. Finance companies are in there. Energy companies are in there. Remember I said right in the early charts, you had some good valuations in banking and in energy and revenue growth. Well, it seems to fit in with what Warren's doing. This is an illustration of the years where going for growth beats value. Now, I check both boxes. I want growth companies, revenue growth, profit growth, and momentum, as well as undervaluation. So discount cash flow is a measure of valuation, shows share price relative to profits, relative to cash flow, relative to sales. And generally, what this is showing is the years where value beats growth, it's in the upper half, and where growth beats value in the lower half. Okay, it's just out of interest. I'm not reading too much into it because I tick both boxes, but value is expected to beat growth this year. All right. And that's why I've had a particular focus on value. And that's why with energy, I'm not picking energy stocks because of the macroeconomic environment. That's something which makes me feel that I'm on the right track. And not just because of momentum, the stocks have gone up, but also because they're still undervalued. Why are they undervalued? Bloody hell, have you seen the price of oil? That stuff still only costs about $10 to dig out of the ground. If you can flog it for over $100, you're making a hell of a lot more than if you're flogging it for $15, right? Price of digging that stuff out of the ground hasn't changed. Maybe a few labor costs have increased. This I really like. What do you know what that is? It's which economies have given, which stock markets, international stock markets have given the highest annual returns. Because people say, oh, well, wait a minute, Alpesh, got this, but what about other parts of the world? You know, should we be looking at other parts? And on the right are the flags of the various countries. Actually, you don't need the flags because the country names are in there. So the flags are there. In 2021, it happened to be India, which was 29% up. In 2020, it was Korea. I guess the big lesson from all of that is don't try and guess a country which is going to win. Because, and we've only looked at the emerging markets here. So that's an emerging markets, okay? So those are all the countries we've looked at and which ones won in which year. There isn't a pattern. Your brain will want to find a pattern. Your brain will say, oh no, if you pick a year when Brazil's up, then the very next year Brazil won't do as well. And so you'll try and find all sorts of patterns. I guess the big lesson is you can't find a pattern. Okay. So this was an interesting piece that I read, which I thought was actually fairly accurate. Stocks might be poised to rally, but brace for another fall. That's great, isn't it? That's Bank of America analyst. Yeah, it might go up, but it might go down. That's bloody useful, mate. Thank you. That's why they pay you the big bucks at Bank of America. This is what they do. They are so much sitting on the fence that they're pulling out splinters from their behinds. Anyway, once the S&P 500 is full, I should get out for a look, short the market because the Fed. I just wanted to show that sometimes things can sound really clever, but really. Tech has consistently been laggard in stagflationary investment environments. Now, that's stagflation again. Economic growth low, inflation high. Tech isn't the place. Guess what does well? You want to know that, don't you? Because we're in that environment. High inflation. Guess what? Energy. And tactically, I've had to shift to energy. Am I an energy expert? No. Do I know much about energy? Have I held energy stocks over the last 20 years? Hardly ever. Hardly ever. Right now, they're the only game in town, really, with a few financials. And yeah, I've still got some of the old tech, but a lot less of it, and we'll wait. But just because it was great for the last 10 years, tech doesn't mean I want to stay in it this year. I might come back to it next year, but we'll see. We're led by the data, and the data suggests on value, growth, income, cash flow that these things are doing better. By the way, trying to pick stocks, I'm not trying to pick which individual companies will do well the year after. This is from the Dow. And the annual returns, highs to lows, which companies won and which companies came bottom. That in itself is not going to help me. What's going to help me every year, and this is why we hold for 12 months, because as you can see, nobody wins every single year. The reason we hold for 12 months and sell if something drops 25% from the peak is because we don't know what's going to happen the year after and the year after and the year after. And that's one reason for that. These are some of the on the trading side. Some of the instruments we've been looking at, because the trends have been smoother on our indicators, and to be able to make those trades has been a lot easier. So sterling, US dollar, 30-minute bars, New Zealand dollar, US dollar, 30-minute bars. So just giving you these, for those of you looking at my pipspredator and looking at the trading side of things, the best and easiest trends have been these, okay? General Electric, 30-minute, Ripple, 1 hour bars. It's just been easier to trade these trends. And a lot of it's about trade selection. JP Morgan said this, Bitcoin's undervalued by 28%. I've told you before, cryptocurrencies, some of you are interested, it's like modern art. I don't know whether it's going to be worth anything in 10 years. But like modern art, it's a load of crap anyway. So, but people keep on selling it for more. So who knows? Or maybe it isn't. Maybe it's wonderful because modern art makes you happy. Some people, you know, if you like to see cows in formaldehyde. Canadian dollar, Swiss franc, another one. Simple trends, 30-minute bar. So keep an eye on these. Swiss franc, Japanese yen. Keep an eye on these for the better, easier trends. And I like to point these out to my clients because I just think you want to go for easier trades. You don't want to make life difficult for yourself. Okay, this is Bitcoin. That's been pretty straightforward, and you can see the direction on that one. Canadian dollar, Swiss franc, again, 1 hour bars. So that's all on my Telegram channel anyway. Litecoin, US dollar. Lots of free tools on alpeshpatel.com alpeshpatelventures.com/links. Now, what I want to show you on this is this. You can, if you haven't already, get a free copy of my book. You can download from that link. You can also follow me on LinkedIn and see some of the latest research and updates that I'm giving. Follow me on Telegram because you'll get about 3 or 4 posts a day with what I think is worth reading, and it's all free. Portfolio review, free. Trading classroom, free if you want to learn about trading. Investing, free if you want to learn about that. Work experience, if you want to get that, free. And free copy of my book, Mind of a Trader, as well. So a shed load of free stuff there, and that's the link. That's the link on there. And that's pipspredator.com. If you're into the trading side of things, we had a revamp of the website. Do check it out. It looks a lot better. Well, we've removed my face off it for a start because that helps, doesn't it? If you want to attract people to something, and we think it's phenomenal. Any questions? Post them now on this. If any of you have got any questions, otherwise have a look at campaignforamillion.com. And boom, I said 20 minutes. Guess what? We're coming up to 20 minutes. Got 18 seconds to spare. Any questions? Anyone at all? I don't think so, which is great if there aren't. But I'll stay on for a little bit longer in case you get them. And let me know if you do. And I'm happy to answer them. And the replays are going to go out. We've got 102 people on here, so that's good. And not one of them's got a question. Time's up. So Rob, hey Chris, James, Robert, Sanjay, Richard, Carwin, Chris, Keith, Ian, Themis, Rupen, Ravi, David, Phil, David, AZ, Tim, another David. There's a lot of Davids. Parents not original. Could have called you Alpesh. Thank you all very much for being on here. Any other questions afterwards, just post them. I'll get them on my inbox and I'll answer them. And I'm going to continue doing these weekly updates as long as you enjoy them and get value out of them, which I hope you do. If you don't, just tell me or don't show up, and then I'll know when I'm talking to an empty room. Thank you all very much indeed, and we are done.